Hi everyone, the topic today is what drives interest rates. I'm here with Rob, our resident guru on everything financial, to hopefully shed some light on the topic. So Rob, I'm going to kick it over to you. What drives rates? How does it all work?
Yeah, thanks Aaron. Look, to really understand what drives mortgage rates in Australia, you need to understand banking. And to break it down into something quite simple, think of a bank as your corner store. It's buying a product and then on selling it to its customers, and a bank's product is basically money.
Yeah, right. Okay, so where do the banks get the money, and what determines their price?
Yeah, so banks have various sources of funding. I mean, the most common and the one they rely on the most is deposits from everyone. But they also look at wholesale debt markets, both here in Australia and overseas. And they also package up mortgages and then on-sell them to institutions in a process called securitisation, and they also have equity. What determines the cost of that? Well, there are a variety of factors. The credit quality of a bank is important, so obviously a CBA is going to find it easier to attract more funding than a Bendigo bank, for example. But you also have the availability of money, and that's really determined by market forces. At the moment there's a lot of liquidity and banks are finding it quite easy to attract funds. And of course one of the major costs of determinant of the cost of money is the level of interest rates, and that's where the RBA comes into play.
Right, so apart from what a lot of people think, it's not just the RBA that sets the rates.
Yeah, correct.
Right.
It is a major factor in terms of what determines the price of money in Australia in the wholesale debt markets, but ever since the GFC, bank funding costs have been determined more around overseas events rather than just being dominated by what the RBA is saying.
Okay, so fixed rates, it's a big thing from our clients, it's a big hot topic. Are they driven by the same things, the same factors?
Yeah, look, same principles. The banks are going out, they're buying money over a longer duration, and then they're passing that on to customers in the form of mortgages or commercial loans. With fixed rates, what you're adding there is the time cost of money. So the longer that you borrow, you'd expect the more that you're going to pay for that privilege.
Okay, and look, I like to always end on this one. What about our clients? How do we work this in from a client point of view? How do they try and work and figure this puzzle out?
Yeah, look, predicting where interest rates are going is notoriously difficult. No one has a crystal ball. And really what it comes down to is interest rate expectations. Interest rate expectations will drive what the Reserve Bank is potentially going to do in its next moves. So if they feel that the economy is not doing so well, then we could expect the interest rates to fall, and that's going to have a flow-on impact to fixed term rates. In terms of what clients should do, well, it's probably good just to take a step back and look at where we are in the interest rate cycle.
Absolutely.
We are pushing record levels or all-time record levels in terms of where interest rates are. So we may not be at the bottom of that cycle, but we're certainly getting close. And it's around this time that those considerations around fixing is very important.
Sure. Well, look, thanks Rob. That's our angle on what drives interest rates. We hope that it helps you understand a little bit more about a really complex topic.